try and have some time at the end to go through more stuff. So just some basic stuff about me. So currently, I'm getting a bachelor's in science in both data science and finance. I'm graduating next year in the spring, and I go to University of Rochester. So personally, I'm also the co-president of the University of Rochester Quantitative Finance Collective. Personally, I develop algorithmic trading strategies, and a lot of my focus is actually on technical analysis and creating much better technical indicators than what's classically available. And we'll get into that. But so the kind of, I wanted to get a show of hands actually of who in this room would consider themselves, a complete beginner, and who in this room, thinks, they've used it somewhat, they've used some kind of technical analysis, they've placed trades. So if you've used like any kind of technical analysis, I just want you to, put some kind of reaction in the chat or just on your screen, like clapping or celebration or something. I just want to see. All right, so we got Sedant, we got Chem, Quill, awesome. All right, so again, I'm definitely going to run off into some advanced territory, but I'm going to try and make it as approachable and digestible as possible, because personally my main focus is in fractal geometry and digital signal processing. So I'm going to try and make that again more inviting for you guys. So I'm just going to start it up. Awesome. So traditional technical analysis, what I just asked you guys about, is essentially just any transformation of historical pricing or volume data, right? So oftentimes, there's many common terms in technical analysis. I'm sure many of you have heard these before, but mean reversion. So trying to figure out where the fair value of a stock is, and trading towards or against that. And this is often thought of as being overbought, oversold, or being in a supply or demand zone. Supports and resistances, that's a whole other thing. This is talking about long range dependence. In these stocks, there's price levels that are repeated over time, and there's some way of measuring that. That's one common thought of technical analysis. Momentum, candlestick patterns. Personally, I have a bias against candlestick patterns. That's kind of the alchemy of technical analysis, in my opinion. So evidence of reliability. The first thing to note is, I'm sure many of you, especially if you're finance students, have heard of the efficient market hypothesis. If you believe in, semi-strong or strong form efficient market hypothesis, you're probably not going to believe in the efficacy of technical analysis. That's just how it is. And there's numerous publicly available academic studies that either discount technical analysis or are a proponent of it. So it's kind of there's a mixed bag of results out there. But what's important to keep in your mind is that winning strategies are not made available to the public. Like, that's just the end of the story. There's millions and millions of different ways that you can approach technical analysis or indicator combinations. So if someone has, there's many people that have, a set or a suite of, technical indicators that they use to trade, and, they've consistently been generating better returns in the market for years. However, obviously they're not giving that to people, or else that opportunity would, dissipate. So moving forward, again, market structure. This is the traditional view of market structure, is the efficient market hypothesis. I can't tell you how many professors I've, had just throwing this in my face saying, prices are efficient or semi-efficient or whatever. And, I've always been extremely skeptical of that. I've been personally trading for, more than 5 years, and algorithmically trading for just about, a year and a half now. And, it's my opinion, and you'll see me support this throughout the presentation, that the efficient market hypothesis is kind of garbage, for lack of a better word. It kind of takes the assumption that prices are a random walk. And what that means is it assumes that, prices have an equal probability of going up as they do going down at any given time. right? And we know from financial market crashes that this just isn't the case. There's discontinuity and there's concentration, right? So if we look back in March, when we had this huge dip in the market, you couldn't tell me that during that week, prices had the same probability of going up as they did going down, when there's a 15% decrease one day, a 20% decrease the next day, and et cetera. So that just doesn't fit into this narrative of having normally distributed prices. And that's something important to know. And this graph right here does a good job of kind of showing you, the efficient market hypothesis is kind of just like an immediate reaction to news. Whereas what we often see is this red line where there's an overreaction and then a subsequent, sell-off that, eventually then comes back to the fair value. So now I'm going to get into the mathematical view of markets, and specifically the fractal view. And I just want to get a poll. If you could drop, a little emoji or a reaction on your screen. If anyone knows what fractals are, or have just heard the term before. Yeah. So basically, the way that you can think about this is fractals are essentially things that are self-similar in scaling. So you can look at a pricing graph at, with 1 minute bars. And if I didn't tell you it was 1 minute bars, and then I took another pricing graph that was hour bars and didn't tell you which was which, there's no way you would be able to tell me which is which, because they're self-similar and at different scales. So you can imagine that, every 1 hour bar is encapsulating, 60 1 minute bars. And, you can choose whatever granularity you want, but the point is that there is essentially this encapsulation of data, 60 points into 4 points, right? Open, high, low, close, right? For every hour. And the same goes for every 2 hours, every day, every week, every month, et cetera. So this kind of fractal view actually, what we're really talking about here is that at every single scale of observation, there's actually different equilibria that are being met, right? So it's not just that there's, one fair value of price. It's actually dependent on the time horizon given this, right? So essentially you can imagine it like, oh, I trade on minute bars. So I'm only concerned about my, minute equilibrium. I'm not, worried about what my, weekly time horizon is or my daily time horizon is, because I'm only concerned about this, very granular set of this economic time series. And, another thing, the fractal market hypothesis, it essentially is the proponent that there is some kind of long-range dependence in the market, right? So that there is, this way that we can measure, supports and resistances, or we can use the past to, help inform our future, or the future of the price in terms of directionality. So continuing on this, dynamic systems, are ubiquitous. Dynamic systems is just a way of saying a system that changes over time, right? So you can think about, like fluid dynamics, you can think about entropy, you can think about, the weather. These are all dynamic systems. And what we're really focused on is dynamic systems, again, with long-range dependence. So, this is, again, the past is kind of informing the future, right? And in the traditional view, that doesn't exist. In the traditional view, we're actually talking about Brown noise, right? This is where the equal probability of going up as it does going down comes into play, right? And there's actually, there's many ways that you can actually study this, but it's actually much more mathematically sound to model financial markets and economic time series as pink noise rather than brown noise. And so we'll move forward into this, but what's interesting to point out is that, there's unique and persistent cycles and trends that are occurring at every single scale, and that influence the scales above and below. And I'm sorry if I'm being too abstract here, but this will make sense as we go on. So now I want to, given this disparity of, what, is kind of more mathematically the case versus what's traditionally the case, we can kind of start to think about what is the problem with technical indicators that are made available to everyone, right? And these are the three biggest, some of the three biggest problems I believe are, in the space of technical analysis right now. So first being that oftentimes indicators, so these indicators are just transformations of either price or volume, right? Indicators often have too much lag, right? So I'm sure many of you have heard of moving averages. We'll get into this, but this all comes down to actually a signal processing task. You can break this down mathematically, and you can actually measure the amount of lag given a certain kind of filter, and we'll get into that. And second, there's too much noise, right? So as I said before, if every time scale has its own horizon, has its own equilibrium, then wouldn't it make sense that the time horizons above and below the scales that you're currently trading actually affect your observation of the current scale? Just think about it this way. Like if there is a massive, trend on the hourly scale, right? It's going up, it's been going up for a while. And on the minute scale, there's just a bunch of, cycles, right? There's just accumulation, distribution. And you're trying to trade somewhere in the middle of that. You want to be able to filter out all of that noise that's happening, at that minute scale and at that hour scale, so you can try and figure out, where that equilibrium might be in the center scale. And I'm sorry if I'm being too convoluted, you can, you can raise your hand and make me clarify. And the third problem is that oftentimes these indicators are too generalized. So if anyone's used any kind of oscillator to trade, whether it be a RSI or a stochastic or some other oscillator like that, one of the only inputs is the look back period, right? So if you have an RSI with a look back period of 10, what many people don't understand is that they're actually, this is again the signal processing task, you're trying to measure inflection points basically with any kind of oscillator. So when an oscillator reaches its maximum, that means that we're expecting some kind of reversal in the underlying price, right? So people are essentially pre-programming and keeping their periodicity of their indicators stagnant throughout, no matter what scale, no matter what time frame, no matter what there's no thought of having some kind of dynamic periodicity with these indicators, when in fact oftentimes that would be extremely useful, rather than just doing a one-size-fits-all approach. So getting into smoothing and lag now. So I mentioned how we can kind of measure these filters against each other, and I just wanted to bring up some of the main methods of smoothing and kind of compare and contrast them. So the first one would be a simple moving average, right? And what I can tell you is that a non-recursive filter, meaning that a filter that has more than just one data point being inputted, has a lag of n minus 1 over 2, right? So if we have a look back period of 10, right, it's going to be 10 minus 1 over 2. And you can say that this 10 bar SMA has a lag of 4.5 bars, meaning that when there's some kind of change in directionality, we're not going to see that come into effect until after 5 or so bars. So you're probably going to miss out on that trade. And many people use weighted moving averages because it oftentimes seems like, all right, I want to be able to weight where my smoothing is, right? But what people don't understand is that the lag produced by the weighted moving average is essentially the center of gravity of those waves. So it's just dynamically changing, and it's not exactly what you want most of the time. And what I can say is that the exponential moving average, as it is a recursive filter, has the least amount of lag of all of the conventional methods, and is most certainly probably has the most use cases. And in my opinion, there's really no reason to ever use a simple moving average or a weighted moving average. It just doesn't make much sense to me at all. why someone would do that. So second, dealing with what's called spectral dilation. And this is kind of the effect that I kind of grazed over earlier, where you have all of these different time scales, and you kind of have to pinpoint the time scale that you're looking at in order to fully understand it better, right? So I have this little animation here, which I think is really fun. And what you can think about is, all of these circles, these 4 circles are equivalent to different time scales. So you can think of, the largest circle being the longest time scale and the smallest circle being the smallest time scale. Again, obviously this doesn't look like, an economic time series, but this is a good way to illustrate what I'm saying. So let's just say that, I'm trying to trade this second time scale right here. Then I would probably want to know what's happening at this time scale, right? So there's a big wave happening at this time scale, and there's much smaller waves happening at time scales below. So, being able to extract away these time scales above and below will actually give me a much better indication of when inflection points are going to happen at the middle time scale. So in practice, it sounds all theoretical, but in practice, the way that you would actually execute doing this is by using what's called high pass and low pass filters. So being able to essentially narrow down the frequency range of which you're observing. So third, autocorrelation. So this is, again, talking about the dynamic programming of indicators. So autocorrelation is one technique of which you can use to do this. So being able to essentially look back into the past and get an estimate of what kind of cycle period you actually should be using. So the way that this would work is, all right, so we're moving through time, right? This red line is moving through time, and it's correlating itself with this position at 0. And you can see that over time, that correlation obviously gets weaker and weaker, but we actually get a better estimate of, how well our current state actually correlates with our past states. And that can give us a better estimate of periodicity than just automatically, just setting, 10 bars, like that's what I'm going to use. So again, there's so many things that could actually go into these types of things. So it's hard for me to actually fully give you a mathematical breakdown of what's going on. But I believe that giving you, these very brief sections of what's wrong and what could be improved and, kind of a how to do it is useful for you guys. And just a good way to think about technical analysis when you're approaching, trading or algorithm trading, right? So now I'm just going to show you visualization of how well they actually perform when we make these kinds of heavy modifications. So maybe some of you have used a moving average convergence divergence. And all that means is, you have one moving average that's, say, at 20, has a 26 bar look back period, and you have one moving average that has a 12 bar look back period. And all it's doing is essentially subtracting one from the other, right? And that just essentially just shows you, all right, so if the 12 bar moving average is crossing above the 26 bar moving average, then that means that there's more momentum and we're likely entering an uptrend, right? So so personally, obviously, again, I build indicators, and you can see the difference right here where we have the traditional MACD above, and, this crossing 0 is the signal, right? So, right here, maybe there's, 4 or so bars of an advantage with my version. Right here, there's like 20 bar advantage. If you look at it from right here where the signal was first generated. And again, there's ways that you can actually, like the way that, again, I've crafted these indicators, makes it so that, they're essentially lagless, and they have a much better understanding of, historical price action. So that's a MACD, and this is an improved stochastic. And this is where we can really actually show you the effects of spectral dilation, because, this is a classic stochastic. And what's really funny is, this is just a perfect example. If I'm trading on a 4-hourly EUR USD graph, right? You know, I don't care about these tiny, cycles that are happening at a lower scale, right? I don't care that, there's a cycle happening here and a cycle happening here and a cycle happening here. All I care about is this grand cycle that's happening on the scale I'm observing, right? This giant, executable trade right there, right? So I don't care about these small little trades. I want to make bigger trades. I want to make trades that actually fit my current time horizon. I don't care about, trading every 2 or 3 bars. I want to trade, more than, 15 or 20, right? So why would I need a signal that's going to tell me what's happening at these lower scales when that's not what I'm concerned about? So this indicator, again, you can see how much clearer the signal generation is. And again, these are both stochastic oscillators, except for one is just very heavily modified. And you can see just the clarity in signal generation that's happening, right? I mean, you're buying here, maybe there's a slight crossover right here. But again, you get a very good idea of the general action that's actually happening here once you move through this process. So next, I'm going to get into some of what I've done personally. So what you see on the left is performance of 5 rules-based trading strategies. So I've crafted 5 different trading strategies, all trade futures. Typically, most of the volumes will be in Euro USD, Euro GBP, lean hogs, actually, believe it or not. What else? I think doesn't matter. But anyways, yeah, all strategies are long short, right? So this is, again, helps it have that neutral beta, no correlation to the market. I'm not even trading equities, so it really wouldn't in the first place. But and win rates averaging about 55 to 60%. And historically, I believe this is, I want to say 7,500 trades. Yeah, 7,500 trades. That makes sense. Yeah. So again, large sample size. This is a 15-year back test. Tick level data, full commissions. I mean, I'm not just saying this. It's just this kind of the point that I don't have another example of using classical technical indicators, because that's not what I'm concerned with. I've kind of just gone off and done my own thing here. But this is kind of just an illustration of how typically you're not going to get these numbers. Like typically these kinds of numbers are often this is like, again, like I wouldn't tell you like what strategies are actually what they're actually doing or what indicators they're actually using. It's kind of just an illustration that this is kind of possible, right? And below you can see just the Markowitz optimized version of the portfolio. And as I mentioned, this is using just a 1% allocation per strategy, but because they're financial derivatives, obviously they're just extremely volatile. So you wouldn't want to put your entire portfolio in there just in case, that's just a bankroll management thing, which is again outside the scope of this presentation. But yeah, so then this is actually something even more so that I've completed recently. So as I mentioned earlier, I'm a data science major and a finance major. So this is actually a machine learning application of many, again, like the core concepts I've discussed, are applicable here. But again, like, it's not like I really gave a roadmap to like get to this place. It's more so of just an illustration of, novel techniques and, just the efficacy of technical analysis in general, right? So what this model actually does, I'm going to be intentionally vague, obviously, but so what happened here was there's 6 different financial instruments: crude oil, treasury bonds, 10 years, Dow Jones futures, soybeans, your USD, and USD JPY. And essentially, if this isn't really a machine learning presentation, but what I can tell you is the rules-based strategies I mentioned, they have an average win rate of 55 to 60%. Whereas this type of strategy actually has a win rate closer to 80 to 85%. So again, starting with rules-based strategies, starting with just the core first principles concepts, and then moving into a more advanced way of strategic development can really boost your trading, right? Because really the first level of trading is, I have an idea, I have a couple indicators, I'm just going to place this trade myself, right? The second level is, all right, I'm going to write a script that, when X, Y, and Z happens, I'm going to short or I'm going to buy, right? And then you can back test that, and, you can see the performance, and you can, kind of measure the validity of taking that into future trades. And then the third step after that is really, not taking yourself away from the decision making and just relying completely on statistics, right? Because, I can say, all right, when X, Y, and Z happens, I want to make a trade, but, that doesn't, a machine learning algorithm can do that much, much better and can actually figure out X, Y, and Z in a much more accurate manner than any human possibly can, right? So again, I'm going to leave, about 15 minutes just to talk to you guys. But I just wanted to mention a couple of things in conclusions and further reading. First, be very suspicious of professors who support, who are teaching you these EMH, things. Just be suspicious of them. That's all I'm going to say. Second, just be as unique and rigorous as you possibly can. Like that's my only advice. That's really what it boils down to. If you try to follow, what X fund or X analyst is doing, you're just always going to be a step behind, right? You want to be 2 steps ahead. So you want to, find something that you believe in, give it a try. You're going to fail, and then you're going to try it again, or you're going to try something different or tweak it, right? I'm not coming here being I'm an expert. I've failed, dozens and dozens of times, building strategies over the last, several years. And, thankfully, I've obviously learned a lot along the way, and I've been able to build much, much better strategies as I've gone forward. So again, don't be afraid to fail. I've failed again so many times, and for reasons that, are so stupid, I can't even mention them today. So third, no one's ever going to teach you how to do this. This is kind of the closest thing that most people will actually get. It's kind of funny that we're even doing this, because traditionally, if I were actively working at a hedge fund right now, they would not let me give this presentation, just straight up. I would be giving too much away, but personally, I don't see much, much of a risk. I didn't really give too much away. I was just kind of pointing at some kind of theoretical concepts that you guys can look at. But, no one's ever going to teach you. You can take as many machine learning classes, you can take as many finance classes as you want. There's no one that's going to say hey, use this indicator and use this, fundamental metric, and you'll be a millionaire. No one, everyone, that the incentives are such that no one's going to tell you anything, and it's all on you, right? So passion and creativity are by far your most important asset. I don't care if someone tells you to take an econometrics class or whatever the hell they tell you. Basically, what I'm saying is, if you care about something, then it's on you to research that and get as far as you possibly can, and just try things, do personal projects. And I can promise you, I can tell you from personal experience, when I go into, interviews with quantitative hedge funds, I spend an hour just talking about my models. They don't even, sometimes they'll just forget to even, talk about, what we were there to talk about in the first place, because you have this passion behind you, you have, these personal projects behind you that they can look at and say, oh, this kid actually knows, what to do, and, he's done it before, and it's not just, he's checking boxes on his resume. He actually gives a shit, right? Forgive me for being so, in your face about this, but I just think it's important. And, the second thing, just reading, if you guys, are interested in this fractal and DSP type of thing, I can give you, some resources here. I mean, I don't know how many of you have heard of Benoit Mandelbrot. He's the guy who discovered the Mandelbrot set. It's one of the most famous fractals. Well, it is the most famous fractal. And I'm not going to get into that. I could talk for hours about that. But Benoit Mandelbrot's entire academic research is, I mean, I can't even tell you. It's just my favorite thing of all time, basically. I don't know. And second, invitation to dynamic systems. Grab it actually. I have it over here. Seconds. This is a great textbook. I actually got this. I don't know where I got this, but it's a great textbook to get into dynamic systems. John Ehlers, awesome guy. He is focused on the DSP side of things. I've actually emailed back and forth with him. He's really nice. And then third, just for any general, investing, like this book right here is muy bueno. For anyone who, really is just looking at getting into quant and just understanding, how people, say Renaissance technologies in the 1990s was able to return 10,000% because they used a model that was used to measure the power of earthquakes, you know what I'm saying? And they applied that to like market making, right? So they had 10,000% over 10 years because they came up with this very unique equation to apply to financial markets. And, this is the kind of thing that, kind of makes me laugh at, people who are proponents of, the efficient market hypothesis, because it feels like to me that they're living, like 20, 30 years in the past before the existence of quant funds. If you're an EMH proponent, then tell me how quant funds exist. Tell me how hedge funds exist. It just doesn't make sense. So, I really like what John was saying in our talk earlier when he was like, you have these academics that, are talking to you about this, and that. Meanwhile, they've never had a day of work in the actual industry. It's kind of what it feels like to me, and it just seems silly. Like, again, I'm not going to, I'm not going to burn any bridges here, but, that's kind of just, I'm a very passionate person about this. And lastly, The Intelligent Investor, that was one of the first books I read years ago when I was really, diving into investing. And that's just, anyone will tell you that's a phenomenal book, even though it is definitely a little efficient marketing. So it's great. But yeah, so now I'm just going to open up to questions if you guys have any. And if you didn't know what the Mandelbrot set is, this is what it is. So thank you everyone for listening to my spiel. I hope you guys enjoyed it, and I hope you guys have some good questions for me. So let them fire.
Hello, can you hear me?
Yep, I can hear you.
Yeah, I'm not sure if we're gonna have enough time to answer this question, but I haven't did algorithmic trading, but I have taken some maths. Do you think the aspects of like linear algebra could help with creation of these systems? Because ultimately, the markets do function like a network where you have to have inputs and outputs, and you can create these solutions per se to react based off of these players, interacting amongst each other.
Yeah, absolutely. And that's kind of the beauty about quantitative finance, is that there's, just millions and millions of different approaches, right? So like you're talking about, linear algebra, I'm talking about fractal geometry, who's to say who's more, whose approach is more profitable or more valid? If you think that, some sector of research is going to help you in development of your algorithmic systems, then give it a try. That's all you have to do. You just have to take that first step. I'm not sure how, computer science, equipped you are, but, it's an awesome tool to, test these kind of things out, and you'll just get quicker and quicker. But yeah, like short answer is yes, absolutely. Just give it a try and you'll figure out, it doesn't work, it does work, and then maybe you can start thinking about why or why not. And I'm sorry, I just want to answer these briefly so I can get to any other questions that are around.
Any implementations in your algorithm that like stop orders after a certain amount of time, or to, as you mentioned, to like prevent bankroll or whatever?
Yeah, so oftentimes in algorithmic trading, and an alteration in your bankroll management is going to be much more effective than, adding another indicator or, tweaking an indicator slightly. You're absolutely right. And, a lot of what, people in the industry will tell you is, average true range is a really great tool. That is one of the things that, algorithmic traders and, just traders in general will tell you to use, because it is something that you can really use to just dynamically set stop losses and take profits. And it's a really, really useful tool. Because once, there's different steps, right? Because once you have your signal generated, you place a trade, and then next thing, right? When do I get out? When, how much loss am I willing to take, to hold this position for the potential profit, right? And that's something that you kind of tweak, right? And again, that's the bankroll management, that's the stop losses and the take profits that you implement on a rolling basis and dynamic basis. Any further questions?
So would you say that your view of the market may be efficiently inefficient? There's actually a really good book titled literally that, Efficiently Inefficient, that kind of discusses how like the market's sort of like a highway, and most drivers go at the same speed, and that sort of affects the normal flow. But then you have some people who are able to navigate in and out of the cars faster than others.
Yeah, so I think that's a good analogy. And, one of my favorite analogies is actually from Mandelbrot. Think about it like a river. How does a river work, right? It takes the path of least resistance. And that's really, a key takeaway that you can, think about here. It's, like what John was talking about with price discovery earlier. I think that's a perfect, analogy. Markets are not efficient. Like, I don't care what, like, I'm sorry that I'm being so convicted right now. There's just zero evidence, in my opinion, that would be the case. So yeah, absolutely. I think that's a good analogy. Any other questions from you wonderful people?
I'm just curious because it seems like there's so many opportunities, especially with the market like moving as itself as this giant like macro beast, that there's a lot of opportunities to find ways to generate alpha, but it's just so, I hear all the time that it's just impossible to generate alpha within quantitative trading. So I guess it's just like, have you been able to like find a consistent flow of alpha, and like, does it disappear over time?
Well, yeah, so I mean, yeah, you're absolutely right. That's absolutely what people will tell you. And because 99.99% of the time it's true. You can't expect to, just plug in like, all right, like I'm just going to put in RSI and, a weighted moving average or whatever. And, I'm just going to let that run on my money and, it'll work out great. Oftentimes, yeah, you're absolutely right. Quantitative trading strategies will often, if they work, maybe they'll only work for, 5 to 10 years. Or, it's very rare that you're going to find something that works for, ever, right? Like that just means that you found some fundamental, I guess, discovery about dynamic systems. And, I'm not going to make any claims about, my personal research in that regard. However, what I can tell you is that the last model I showed you, that precision score of 80 to 85% was actually taken over, I want to say so all of the samples that I used, there were 600,000 samples. And I used a 70 to 30% train test split, which would mean that the data that I used to get that 80% score was roughly around 200,000 samples. And if you guys are familiar with statistics, that more than rejects the null hypothesis. If you guys can calculate p-values on that. But, I really just think about this from a statistical standpoint, right? Because when you backtest, you want to make sure that you have enough samples so that it's actually statistically meaningful, right? Because if you make a strategy that only trades 5 times and you're like, oh, I made 2,000%, that doesn't mean anything. And the same thing goes for like retail trading in general, right? Like we all have these friends that are like, all right, like, I just made like 5% in the last month. Meanwhile, they made like 2 trades, it's just like silly. And like, people don't understand this. Like, it's just not statistically reliable. In my opinion, I don't think again, this is going to be a controversial thing to say, but I don't think that non-algorithmic trading, just like trading on, conviction is reliable whatsoever. I just think that there needs to be, statistical evaluations. There needs to be, some kind of, back testing and rigorous analysis. I'm not saying you can't do that. I'm just saying in terms of if I'm taking algorithmic trading versus, just day trading, like algorithmic trading is going to win 10 times out of 10, in my opinion. But I do believe we're right about at the end of our time. I can probably squeeze in one more question if there's a burning question, but other than that, thank you guys very much for being here and for asking some really good questions. So if you guys, I'm sure did you guys copy and paste that, the last link by chance? I'm gonna find it right now and send it.
Yeah,
sorry that
Blake's in the room. So,
all right, awesome, dude. Can you send? Oh, you have the link. Awesome. Right, Chem has it. Great. All right. So thank you guys. See you with.